Okay, so this is self-learning for CA Final DirectX. Chapter 1, Basic Concepts. Okay, so after studying this chapter, you will be able to recap the basic concept of income tax law, its components, and the meaning of imported terms used. Interpret the provisions of income tax law by applying the rules of interpretation. Examine whether a receipt is capital or revenue in nature in the context of the provisions of the income tax law. Appreciate the difference between application of income and derivation of income by overriding title. Examine the circumstances when income of the previous year would be assessed to tax in previous year itself. Appreciate the difference in the rate of taxes and surcharge applicable to different categories of person. Apply the rates of tax applicable to different components of the total income of a person and the rates of surcharge wherever applicable in health and education such for the purpose of determining the tax liability of such person. Chapter overview. Components of income tax law, rules of interpretation, important definition, charge of income tax, rates of tax and surcharge. Overview of income tax law in India. The Constitution of India in Article 265 lays down that no tax shall be levied or collected except by authority of law. Accordingly, both the levy of tax as well as its collection shall be made under a law framed by the government. Constitution of India means there should be a law which will levy and collect the tax. Constitution of India gives the power to levy and collect taxes, whether direct or indirect, to the central government and state government. The parliament and state legislatures are empowered to make laws on the matters enumerated in the 7th schedule by virtue of Article 246 of the Constitution of India. The 7th schedule to Article 246 contains 3 lists which enumerate the matters under which the parliament and the state legislatures have the authority to make laws for the purpose of levies of taxes. The following are the list. Union list or list number 1, that is Parliament has exclusive power to make laws on the matter contained in the Union list. State list or list 2, that is legislature of any state has the exclusive power to make laws on the matters contained in the state list. And number 3 is concurrent list or list 3. Both Parliament and state legislatures have the power to make laws on the matter contained in the concurrent list. So as per list 1, Parliament, as per list 2, state, and as per list 3, both has the power. Income tax is the most significant direct tax entreated over the union list. That is list number 1 in the 7th schedule or to Article 246 of the Constitution of India have given the power to the Parliament to make laws on taxes on income other than agriculture income. Income tax is a tax levied on the total income of the previous year of every person. A person includes individual, HUF, association, AOP, body of individuals, a firm, company, etc. Income tax law in India consists of the following components: Income Tax Act, Annual Finance Act, income tax rules, circulars, notifications, legal decisions of court. The various instruments of law containing the law relating to income tax are explained below. Income Tax Act 1961. The levy of income tax in India is governed by the Income Tax Act 1961. In this material, we shall briefly refer to this as the Act. It extends to the whole of India. It came into force on 1st April 1962. It contains Section 1 to 298 and Schedule 1 to 14. It undergoes a change every year by the Annual Finance Act passed by Parliament and other legislations like Taxation Laws Amendment Act. The Finance Act. Every year, the Finance Minister of the Government of India introduces the Finance Bill in the Parliament budget session. When the Finance Bill is passed by both the houses of the Parliament and gets the assent of the President, it becomes the Finance Act. New provisions are inserted, existing provisions are substituted or amended every year in the Income Tax Act 1961 and other tax laws by the Finance Act. The first schedule to the Finance Act contains 4 parts which specify the rates of tax. Part 1 of the first schedule to the Finance Act specifies the rate of tax applicable to the current assessment year. Accordingly, Part 1 of the first schedule to the Finance Act 2025 specifies the rate of tax for the assessment year 25-26, that is financial 24-25. Part 2 specifies the rate at which tax is deductible at source for the current financial year. Accordingly, Part 2 of the first schedule to the Finance Act 2025 specifies the rate at which tax is deductible at source for financial year 25-26. Part 3 gives the rate for calculating income tax, for deducting tax from income chargeable under the head salaries, and computation of advance tax for financial year 25-26, where the SSE exercises the option to shift out of the default tax regime provided under Section 115 BSE 1A. Part 4 contains the rules for computing net agriculture income. Income Tax Rules 1962. The administration of direct taxes looked by the Central Board of Direct Taxes. The CBT is empowered to make rules for carrying out the purpose of the Act. For the proper administration of the Income Tax Act 1961. The CBT frames rules from time to time. These rules are collectively called Income Tax Rule 1962. Rules also have sub-rules, provisions, and explanation. The proviso to the rule, sub-rule spells out the exceptions to the limits, conditions, guidelines, basis of valuation as the case may be. Spells out in the rule or sub-rule. The explanation gives clarification for the purposes of the rule. It is important to keep in mind that along with the Income Tax Act, these rules should also be studied. Clarification and circulars and notification. Circulars are issued by the CBDT from time to time to deal with certain specific problems and to clarify doubts regarding the scope and meaning of certain provisions of the Act. Circulars are issued for the guidance of the officers and of the SSC. The department is bound by the circulars. While such circulars are not binding on the SSC, they can take advantage of beneficial circulars. Notification. Notifications are issued by the CG to give effect to the provisions of the Act. Example, under section 1015 for H, interest payable by any public sector company in respect of such bonds or debentures and subject to such conditions as the CG may, by notification in the official gazette specify in this behalf, would be exempt. Therefore, the bonds and debenture, interest on which would qualify for exemption in this section are specified by the central government through notification. The CBDT is also empowered to make and amend rules for the purpose of the Act by issuing notification which are binding on both department and SSC. Under section 35 CCD, the CBDT is empowered to prescribe guidelines for notification of skill development project. Accordingly, the CBDT has wide notification number 54/2013 dated 15 July 2013 prescribed Rule 6AAF laying down the guidelines and conditions for approval of skill development project under section 35 CCD. The study of case law is an important and unavoidable part of the study of income tax law. It is not possible for the Parliament to conceive and provide all possible issues that may arise in the implementation of any act. Hence, the judiciary will hear the disputes between the SSC and the department and give decision on various issues. The Supreme Court is the apex court of the country, and law laid down by the Supreme Court is the law of the land. The decision given by various high courts will apply in respective states in which such high courts have jurisdiction. Rules of interpretation. Rules of interpretation are principles that have evolved over the year on account of interpretation of provisions of law by various courts. These rules help in interpretation of law. The object behind use of these rules is to ascertain the intention of the lawmakers. These rules are not static and keep on evolving. At times, there may be more than one rule of interpretation which appear to applicable to a given situation. The court then decides the most appropriate one in the given situation, considering the facts of the case. In the ensuing paragraph, we have made an attempt to discuss the rules of interpretation largely in the context of income tax law, citing appropriate instances. Significant rules of interpretation used by court. Rule of literal interpretation. This rule is based on the age-old doctrine that judges do not legislate, they only interpret law. This stipulates that the intention of the legislation must be found in the words used by the legislature itself. Attention must be given to what has been said and also what has not been said. Nothing should be added or subtracted. If the provision is unambiguous and if from that provision the legislative intent is clear, the other rules of construction of statutes need not be called into aid. Mischief rules. The mischief rule originated in 16th century in the Haydn's case in the United Kingdom. It is commonly known as the Haydn's rule or purposive construction. In this rule, the position before an amendment or enactment of an act is examined to find out the mischief shown to be remedied to determine the rationale for the remedy. In order to do so, the following aspects are looked at. What was law before the provision was introduced or amended? What was the mischief or the defect for which the earlier provisions of law did not provide a remedy? What remedy has the Parliament effected in the provision of law to cure the mischief of defect? What is the intended effect of such remedy? Court then have to make construction that suppresses the mischiefs and advances the remedy. The golden rule. It allows a judge to depart from a word's normal meaning in order to avoid an absurd result. It is a compromise between the literal rule and the mischief rule. Like the literal rule, it gives the words of a statute their plan ordinary meaning. However, if this leads to an irrational result, which is unlikely to be the legislature's intention, the court can depart from this meaning. In such a case, the court would also look at the context in which a provision appears. The same words may mean one thing in one context and another in a different context. While ascertaining the true intention of the legislature, the court must not only look at the words used by the legislature, but also have regard to the context and the setting in which they occur. The meaning of words in an enactment is not to be ascertained by reading them in isolation. Rule of harmonious construction. The entire statute must be read as whole. Further, all parts of a section should be read harmoniously. Construction should be such that it provides meaning to all parts of a statute. A construction which creates inconsistency or repugnancy between the various sections or parts of the statute should be avoided. Principle of beneficial construction. If the court finds that two views are possible, construction which is most beneficial to the taxpayer should be adopted. This principle is also widely used in interpretation of fiscal laws. Apart from these rules, there are several other rules such as adjustem generis, nocitur e socius, and stare decisis, which are often used by the court. Rule of adjustem generis is used when particular words pertaining to a class, category, or genus are followed by general word. In that case, general words are construed as limited to thing of the kind. The principle of nocitur associus implies that meaning of a word may be ascertained by reference to words associated with it. Words derive color from the surrounding words. The principle of stare decisis stipulates that a view which is operating for long and is accepted and acted upon should not be easily departed from. Interpretation of different provisions of the Income Tax Act 1961. In context of the Income Tax Act 1961, the ensuing table summarizes how different types of provisions are typically construed by court. Types of provision, charging provision, and interpretations. So for charging provisions, the tax is levied by a charging section, that is, it imposes a charge or liability to pay tax. If a person has been brought to tax within the ambit of the charging section, by clear word, he has to be taxed subject to specific exemption or deduction, if any available under the provisions of the Act. Charging section should be strictly construed. Machinery provision. Machinery provisions provide machinery for assessment and collection of charge created by the charging section. Machinery and charging provisions constitute an integrate code. The machinery provisions should be construed in a way that makes the machinery workable. Penal provisions. The penal provisions are required to be construed in a strict manner. In case of ambiguity, the taxpayer should be entitled to the benefit of doubt. Deeming provision is intended to enlarge the scope of chargeability of income under a particular head or scope of coverage of a certain provision. It includes matters which otherwise may or may not fall within the provision. Deeming provision should be strictly construed. It should be given in full effect and carried to its logical conclusions. Appeal and refund provision. The taxpayer has a right to appeal only if there is a statutory provision for the same. It cannot be implied. Appeal provisions should be liberally construed in a reasonable and practical manner. Similarly, provisions granting refund must also be read liberally in favor of the taxpayer. Provisions giving exemptions and relief. Provisions giving deduction, exemptions, or relief should be interpreted liberally and in favor of taxpayer. They should be construed to effectuate the object of legislature and not to defeat it. Aid to interpretation. An aid is a device that helps to assist courts in interpretation of statutes. They can be broadly classified as internal aid or external aid. Internal aids to construction. Internal aids to construction refers to aid present within the statute itself, such as the long title, the preamble, heading, marginal notes, punctuations, definitions, sections, provisos, and explanations. Let us now examine some of these. Explanation is a generally mean to explain or clarify the meaning of certain words and expressions contained in the main provision. Explanations appended to a section is an integral part of the section. It does not have independent existence apart from the section. In exceptional cases, an explanation may widen the scope of the main section by introducing a legal fiction. Provisos. Generally, the function of a proviso is to carve out an exception or condition to qualify a proviso. A proviso cannot control the enactment. The proviso is not applicable unless the main provision is applicable to the facts of the case. It must be construed harmoniously with the main provision. Example, Section 80 GGB and 80 GGC provides for deduction from gross total income in respect of contributions made by companies and other persons respectively to political parties or an electoral trust. The proviso to section 80 GGB and 80 GGC provides that no deduction shall be allowed under those sections in respect of any sum contributed by cash to political parties or an electoral trust. Thus, the provisos to these sections spell out the circumstances when deduction would not be available thereunder in respect of contributions made. The explanation below, section 80 GGC, provides that for the purpose of section 80 GGB and 80 GGC, political party means a political party registered under section 29A of the Representation of the People Act 1951. Thus, the explanation clarifies that the political party has to be registered political party. Non-obstinate clause. Non-obstinate clause is a clause which begins with the phrase notwithstanding anything contained in any other provisions of the Act or notwithstanding anything contained in a particular provisions of the Act. Use of this phrase shows that the intent of lawmaker is to give it an overriding effect in case of a conflict over the other provisions of the statute mentioned in the provision. Example, section 43B provides deduction of certain specified sums for computing of income under the head profit and gains from business or profession on actual payment basis. It begins with the phrase notwithstanding anything contrary in any other provisions of this Act. Thus, it overrides the other provisions of the Act and provides deduction of payment or expenditure specified therein only on the basis of actual payment. Marginal notes and headings. Headings may be prefixed to a section or a group of sections. Marginal notes are the notes which are inserted at the side of the sections in a statute and express the effect of the section stated. Headings and marginal notes cannot control the plain words of the provisions. Only in case of ambiguity they may be referred to throw light on intention of legislature. Definition clause is an undefined words. The object of a definition clause is to avoid the necessity of frequent repetition in describing the subject matter in the statute. When the statute defines a particular word, the same should be used unless the context otherwise requires. A word occurring more than once in a statute should be generally given the same meaning unless the context requires otherwise. Words not specifically defined must be taken in their legal sense. Dictionary meaning, commercial or common meaning, definition from any other statute cannot be borrowed and used ignoring the definition contained in the statute itself. In the Income Tax Act 1961, definitions contained in section 2 are for the purpose of the Income Tax Act 1961. However, definitions contained in a particular chapter of the Income Tax Act 1961 are generally relevant only in the context of the provisions related to that chapter unless reference to such definition has been made in any other provisions or chapters of the Act. External aids to construction. External aid refers to aids which are external to the statute such as legislative history, dictionaries, foreign decisions, reference to other statutes. Let us examine some of them. Legislative history. Historical setting cannot be used as an aid if the words are plain and clear. If the wordings are ambiguous, one can look at historical facts and circumstances that prevailed at the time when the law was passed for determining the object and purpose. Reports of commission, including law commission or committee, including parliamentary committee preceding the introduction of a bill, can also be referred to as evidence of historical facts surrounding circumstances of mischief or mischiefs intended to be remedied. Circulars. CBDT circulars issued under Section 119 of the Income Tax Act 1961 are binding on the tax officers and persons employed in the execution of the Income Tax Act 1961. They express the views of CBDT on any issue. They are, however, not binding on the appellate authority, tribunal, courts, or the taxpayer. Taxpayer can, however, take benefit of beneficial circulars. Speech. The speech made by the mover of the bill can also be used to ascertain the mischief sought to be remedied. The object and purpose of the legislation, however, speech made by the members of the parliament at the time of consideration of a bill are not admissible as an aid. Explanation memorandum. Notes on clauses and a memorandum explaining the provisions of the finance bill can also aid in construction in case of ambiguity. Dictionary meaning. The dictionary meaning of a word should not be looked at where the word has been statutorily defined or judicially interpreted. However, when there is no such interpretation or definition, the court may take aid on dictionaries to ascertain the meaning of the word. Important definitions. 1.2. In order to understand the provisions of the Act, one must have the thorough knowledge of the meaning of certain keys, terms like assessment to your person, SSC, income tax, income, etc. To understand the meaning of these terms, we have to first check whether they are defined in the Act. Terms defined in the Act, Section 2 gives definition to the various terms and expressions used therein. If a particular definition is given in the Act itself, we have to be guided by the definition. For example, the term perquisite has been defined under Section 17, subsection 2 for the purpose of taxation of salaries. Terms not defined under the Act. If a particular definition is not given in the Act, reference can be made to the general clause, Act, or dictionary. Students should note that this point carefully because certain terms like dividend, transfer, etc. have been given a wider meaning in the Income Tax Act 1961 than they are commonly understood. Some of the important terms defined in under Section 2 are given below. SSE, Section 2, subsection 7. SSE means a person by whom any tax or any other sum of money is payable under this Act. In addition, it includes every person in respect of whom any proceeding under this Act has been taken for the assessment of his income or the income of any other person in respect of which he is assessable, or the loss sustained by him or by such other person, or the amount of refund due to him or to such other person. Every person who is deemed to be an assessee under any provisions of this Act. Every person who is deemed to be an assessee in default under any provisions of this Act. Every person is a person, but every person need not be an assessee. Assessment, Section 2, subsection 8. This is a procedure by which the income of an assessee is determined by the assessing officer. It may be by way of a normal assessment or by way of reassessment of an income previously assessed. Type of income tax assessment: self-assessment under Section 140A, summary assessment under Section 143(1), scrutiny assessment under Section 143 subsection 3, base judgment assessment under Section 144, reassessment or income escaping assessment under Section 147. Person, Section 2, subsection 31. The definition of the SSE leads us to the definition of a person as a former is closely connected with the latter. The term person is important from another point of view also, that is the charge of income tax is on every person. The definition of the term person is inclusive and not exhaustive. The different types of persons recognized under the Act are provided in the diagram below. Individual, HUF, company, firm, AOP, BOI, local authority, artificial, judicial person, all are the person. We may briefly consider some of the above 7 categories of SSE, each of which constitute a separate unit of assessment or a separate tax entity. Individual. The term individual means only a natural person, it is a human being. It also includes a minor or a person of unsound mind. But the assessment in such a case may be made under Section 161, subsection 1 on the guardian or manager of the minor or lunatic who is entitled to receive his income. In case of deceased person, assessment would be made on the legal representative. HUF. Under the Income Tax Act 1961, HUF is treated as a separate entity for the purpose of assessment. It is included in the definition of the terms person under Section 2, subsection 31. The levy of income tax is on every person. Therefore, income tax is payable by HUF. Hindu undivided family has not been defined under the Income Tax Act 1961. The expression is, however, defined under the Hindu law as a family which consists of all males lineally descended from a common ancestor and includes their wives and daughters. Refer Chapter 9, Assessment of Various Entities in Module 2 of the detailed discussion of HUF. Company, Section 2, subsection 7. For all purpose of the Act, the term company has a much wider connotation than that under the Companies Act 2020. Under the Act, the expression company means any Indian company as defined in Section 2, subsection 26, or any body corporate incorporated by or under the law of a country outside India, it is any foreign company, or any institution, association, or body which is assessable or was assessed as a company for any assessment year under the Indian Income Tax Act 1922, or any assessment year commencing on or before 1st April 1970 under the present Act, or any institution, association, or body, whether incorporate or not, and whether Indian or non-Indian, which is declared by a general or special order of the CBDT to be company for such assessment year, as may be specified in the CBDT's order. Classes of companies: domestic company and foreign company. Companies can be classified into 2 categories: domestic and foreign companies. Domestic company, Section 2, subsection 22A. It means an Indian company or any other company that has made the necessary arrangement to declare and pay dividend, including those on preference shares within India, for its income that is subject to income tax. Indian company, Section 2, subsection 20. A company is incorporated in considered as an Indian company under Section 2, subsection 26 of the Income Tax Act 1961 if it meets 2 key conditions: formation and registration. The company should have been formed and registered under the Companies Act 1956. Office or location. The company registered or principal office should be in India. Additionally, the term Indian company also includes the following, provided the registered or principal office in India. Corporation established by or under a central, state, or provincial act, such as financial corporation or state road transport corporation. Institution, association, or body declared by the board to be a company under Section 2, subsection 17, clause 4. Company formed and registered under any law in force in any part of India excluding Jammu and Kashmir and specific union territories. Company formed and registered under any law in force in Jammu and Kashmir. Company formed and registered under any law in force in union territories like Dadra and Nagar Haveli, Daman and Diu, Pondicherry or the state of Goa. Foreign company, section 2, subsection 23A. Foreign company means a company which is not a domestic company. Classes of company are domestic company, there is Indian company, company which has made arrangement or for declaring and paying dividend within India out of the income chargeable to tax in India. Foreign company, a company which is not a domestic company. Company is further classified into two primary categories based on a public interest. Widely held company, company in which public are substantially interested. A company is considered to have substantial public interest if it meets any of the following criteria as outlined in section 2 subsection 18 of the Income Tax Act 1961. Government or RBI ownership or participation. A company owned by the central or state government or the Reserve Bank of India, or where at least 40% of the shares are held, whether singly or taken together by the government or the RBI, or a corporation owned by RBI. Company registered under Section 25 of the Companies Act 1956. Company registered under Section 25 of the Companies Act 1956, which is formed to promote commerce, arts, science, education, research, social welfare, charity, environmental protection, etc., and does not contribute dividend to their does not distribute dividend to their members. Companies with no share capital and declared by the CBDT. Company which does not have share capital and is declared by the CBDT to be a company in which the public are substantially interested for specified assessment year. Mutual benefit finance company, Nidhi or mutual benefit company, society. A company that primarily accepts deposits from its members and is declared by the central government under Section 620A of the Companies Act 1956 to be a Nidhi or a mutual benefit company. Cooperative society ownership. A company whose equity shares are carrying at least 50% of the voting power are unconditionally allocated or allotted or acquired by one or more cooperative societies and held throughout the relevant previous year. Public limited company. A company which is not a private company as defined in the Companies Act 1956 and which fulfill any of the following conditions. In its equity shares were listed in a recognized stock exchange in India as on the last day of the relevant previous year, or its equity share carrying at least 50%, 40% in case of an Indian company in ship construction business or manufacturing or processing of food, or in mining or generation or distribution of electricity or any other form of power. Voting power have been unconditionally allocated to or acquired by and should have been beneficially held throughout the relevant previous year by government or statutory corporation or a company in which public are substantially interested, or any wholly owned subsidiary of company mentioned in C. Closely held company. Company in which public are not substantially interested. Any company that does not meet the criteria for being classified as a widely held company is considered closely held company. Thus, all private limited company will be treated as companies in which public are not substantially interested. Refer Chapter 9, Assessment of Various Entity in Module 2 for detailed discussion of companies. Firm, Section 2, subsection 23. The term firm, partner and partnership have the same meaning as assigned to them in the Indian Partnership Act 1932. In addition, the definition also includes the terms limited liability partner, a partner of limited liability partnership as they have been defined in the Limited Liability Partnership Act 2008. In an LLP, since liability of a partner is limited to their agreed contribution therein, it contains elements of both a corporate structure as well as a partnership firm structure. However, for income tax purpose, a minor admitted to the benefit of an existing partnership would also be treated as a partner. Firm as defined under the Partnership Act 1932 as defined in the Limited Liability Partnership Act 2008. A partnership is the relation between a person who has agreed to share the profits of a business carried on by all or any of them acting for all. The person who have entered into partnership with one another are called individually partners and collectively a firm. Association of persons. When persons combine together for promotion of joint enterprise, they are assessable as an AOP. When they do not in law constitute a partnership. In order to constitute an association, person must join for a common purpose or action, and their object must be to produce income. It is not enough that the person receive the income jointly. Co-hires, co-legatees or co-donees joining together for a common purpose or action would be chargeable as an AOP. For example, Mr. Yes, AB and Company, Firm and XP Private Limited join together to carry on a construction activity, otherwise than a partnership firm. Such an association will be recognized as an association of persons. Next, body of individual. Body of individual refers to a conglomeration of individuals who carry on some activity with or without object of producing income. It denotes the status of persons like executors or trustees who merely receive the income jointly and who may be accessible in like manner and to the same extent as the beneficiary individually. beneficiaries individually. Thus, co-executors or co-trustees are assessable as a body of individuals as their title and interest are indivisible. Income tax shall not be payable by a assessee in respect of the receipt of share of income by him from body of individual on which the tax has already been paid by such body of individual from mutual trade association, member club, etc. Section 2, subsection 31 further explains that an association of person or body of individuals or a local authority or an artificial judicial person shall be treated as a person whether or not it is formed with the object of deriving income, profit or gains. Accordingly, even if such entities have been formed not for earning any income or profit, they are person for the purpose of the act and are covered by the provisions of the act. Difference between AOP and BOI. In case of an AOP only, in case of BOI only individuals can be the members, whereas in case of AOP any person can be its member. That is, entities like company, firm, etc. can be member of AOP but not of BOI. In case of AOP, members voluntarily come together with a common will for a common intention or purpose, whereas in case of body of individuals, such common will may or may not be present. Local authorities. The term means a municipal committee, district board, body of port commissioners, or other authorities legally entitled to or entrusted by the government with the control or management of a municipal or local one. A local authority is taxable in respect of that part of its income which arises from any business carried on by it in so far as that income does not arise from the supply of a commodity or service within its own jurisdictional area. However, income arising from the supply of water, electricity, even outside the local authority's own jurisdictional area is exempt from tax. Artificial judicial person. Artificial judicial person are the entities which are not natural person but are separate entities in the eyes of law. This is a residual category, could cover all artificial persons with a juristic personality and not falling under any other category of persons. Deities, bar council, universities are some important examples of artificial judicial person. Income. Section 2, subsection 24. Definition of income. The definition of income as per the Income Tax Act 1969 begin with the words income includes. Therefore, it is an inclusive definition, not an exhaustive one. Such a definition does not confine the scope of income, but leaves room for more inclusions within the ambit of the term. Section 2, subsection 24 of the Act gives a statutory definition of income. At present, the following items of receipts are specifically included in income. Profit and gains, dividends, voluntary contribution received by a trust or institution created wholly or partly for charitable or religious purpose by or by an association or institution referred to in section 1021 or by a fund or institution referred to in section 1023C, 3AD, 3AE or 4, 5, 6, 6A or an electoral trust. Research association approved under section 35, 1, 2, 3, 1021. Universities and other educational institutions 1023C, 3AD, oblique 6. Hospitals and other institutions 1023C, 3AE, oblique 6A. Notified fund or institutions established for charitable purpose 1023C4. Notified trust or institutions established wholly for public religious purpose or wholly for public religious and charitable purpose 1023C5. Electoral trust 13B. The value of any perquisites or profit in lieu of salary taxable under section 117(2) and 3 respectively. Any special allowance or benefit other than the perquisites included above specifically granted to the SSC to meet expenses wholly necessary and exclusively to the performance of the duties of an office or employment of profit. Any allowance granted to the SSC to meet his personal expenses at the place where the duties of his office or employment or profit are ordinarily performed by him, or at the place where he ordinarily resides, or to compensate him for the increased cost of living. The value of any benefit or perquisite, whether convertible into money or not, obtained from a company either by a director or by a person who has a substantial interest in the company or by a relative of the director or such person, and any sum paid by any such company in respect of any obligation which but for such payment would have been payable by the director or other person aforesaid. The value of any benefit or perquisites, whether convertible into money or not, which is obtained by any representative SSC mentioned under section 1060 under section 160 subsection 1 clause 3 and 4, or any beneficiary or any amount paid by the representative SSC for the benefit of the beneficiary which the beneficiary would have ordinarily been required to pay. Deemed profit chargeable to tax under section 41 or section 59. Profit and gains of business or profession chargeable to tax under section 28, 2, 3, 3A, 3B, 3C, 4, 5, 5A, or the value of any benefit or perquisite taxable under section 28, 4. Any capital gains chargeable under Section 45. Profit and gains of any insurance business carried on by a mutual insurance company or by a cooperative society, computed in accordance with Section 44, or any surplus taken to be such profits and gains by virtue of the provisions contained in the first schedule to the Act. The profit and gains of any business of banking, including providing credit facilities carried on by a cooperative society with its members, any winning from lotteries, crossword puzzles, races, including horse race, card games, and other games of any sort, of from gambling or betting or any of any form or nature whatsoever for this purpose. Lottery includes winning from prizes awarded to any person by draw of lots or by chance or by or in any other manner whatsoever under any scheme or arrangement by whatever name called. Card games and other game of any sort includes any game show, an entertainment program, or television or electronic mode in which people compete to win prizes or any other similar games. Any sum received by the SSC from his employees as contribution to any provident fund or superannuation fund or employee state insurance fund or any other fund for the welfare of such employees. Any sum received under a Keyman insurance policy, including the sum allocated by way of bonus of on such policy will constitute income. Keyman insurance policy means a life insurance policy taken by a person on the life of another person, whether the latter is or was an employee or is or was connected in any manner whatsoever with the former business. It also includes such policy which has been assigned to a person with or without any consideration at any time during the terms of the policy. Any sum referred to in Section 28 5A, any sum whether received or receivable in cash or kind under an agreement for not carrying out any activity in relation to any business or profession or not sharing any know-how, patent, copyright, trademark, license, franchise, or any other business or commercial right of a similar nature, or information or technique likely to assist in the manufacture or processing of goods or provision of services shall be chargeable to income tax under the head profit and gains of business or profession. Fair market value of inventory as on the date on which it is converted into or treated as a capital asset determined in the prescribed manner. Section 28 6A. Any sum of money received as advance, if such sum is forfeited consequent to failure of negotiations for transfer of a capital asset. Section 56 to 9. Any sum of money or value of property received without consideration or for inadequate consideration by any person. Section 56 to 10. Any compensation or other payment due to or received by any person by whatever name called in connection with the termination of his employment or modification of the terms and conditions relating thereto. Section 56 to 11. Any specified sum received by unit holder from a business trust during the previous year with respect to a unit held by him at any time during the previous years. 56 to 12. Any sum including the amount allocated by way of bonus under a life insurance policy other than under a ULIP and Keyman insurance policy which is not exempt under Section 1010D to the extent the sum exceeds the aggregate of the premium paid during the term of the policy and not claimed as deduction under any other provisions of the Act. Section 56 to 13. For detail, refer Chapter 5, Income from Other Sources. Assistance in form of subsidy or grant or cash incentive or duty drawback or waiver or concession or reimbursement by whatever name called by the CG or SG or any authority or body or agency in cash or in kind. SSC is included in the definition of income. Subsidy or grant which are not included in definition of income under Section 2 subsection 24. Subsidy or grant or reimbursement taken into account for determining the actual cost of depreciable assets in accordance with Explanation 10 to Section 43(1). Subsidy or grant by the CG for the purpose of the corpus of a trust or institution established by CG or state government as the case may be. Concept under the Income Tax Act 1961, regular receipt versus casual receipt. Income in general means periodic monetary return which accrues or is expected to accrue regularly from definite source. However, under the Income Tax Act 1961, even certain casual receipts which do not arise regularly are treated as income for tax purpose. Example, winning from lotteries, crossword puzzles, etc. Revenue receipt versus capital receipt. Income normally refers to revenue receipts. Capital receipts are generally not included within the scope of income in general parlance. However, the Income Tax Act 1961 has specifically included certain capital receipts within the definition of income. Capital gains, that is example, that is a capital gain, that is gains on sale of capital assets like land and jewelry. Not receipt versus gross receipt. Income means net receipt and not gross receipt. Net receipts are arrived at after deducting the expenditure incurred in connection with earning such receipts. The expenditure which can be deducted while computing income under each head is prescribed under the Income Tax Act 1961. Income from eligible assess a certain eligible business or profession is also determined on presumptive basis, that is, as a certain percentage of gross receipts. Due basis, that is or versus receipt basis. Income is taxable either on a due basis or receipt basis. For computing income under the head profit and gains of business or profession and income from other sources, the method of accounting regularly employed by the SSC should be considered, which can be either cash system or market system. Some receipts are taxable only on receipt basis, like income by way of interest received on compensation or enhanced compensation. Application of income versus diversion of income. Application of income means to discharge an obligation which is gratuitous or self-imposed after such income reaches the SSC, whereby virtue of an obligation by overwriting title, income is diverted before it reaches the SSC. Before it reaches us, it is known as diversion of income. In case of former, the income would be taxable in the hands of the person who applies it, whereas in the case of the latter, it is not taxable. That even if the SSC were to collect the income, he does so on behalf of the person to whom it is payable. Concept of revenue and capital receipt. Students also carefully study the various items of receipts included in the definition of income. Some of them, like capital gains, are not revenue received. However, since they have been included in the definition, they are chargeable as income under the Act. The concept of revenue and capital receipt is discussed here under. The Act contemplates a levy of tax on income and not on capital, and hence it is very essential to distinguish between capital and revenue receipts. Capital receipts cannot be taxed unless they fall within the scope of the definition of income, and so the distinction between capital and revenue receipt is material for tax purposes. Certain capital receipts which have been specifically included in the definition of income are compensation for modification or termination of service, income by way of capital gain, etc. It is not possible to lay down any single test as infallible or any single criteria as decisive, final, and universal in application of determining whether a particular receipt is capital or revenue in nature. Hence, the capital or revenue nature of the receipt must be determined with reference to the facts and circumstances of each case. Criteria for determining whether a receipt is capital or revenue in nature. The following are some of the important criteria which may be applied to distinguish between capital and revenue receipt. Fixed capital or circulating capital. A receipt referable to fixed capital would be a capital receipt, whereas a receipt referable to circulating capital would be a revenue receipt. The former is not taxable while the latter is taxable. Tangible and intangible assets which the owner keeps in his possession for making profit are in the nature of fixed capital. The circulating capital is one which is turned over and yield income or loss in the process. Income from transfer of capital assets or trading assets. Profits arising from the sale of capital assets are chargeable to tax as capital gains under section 45, whereas profit arising from the sale of trading assets being of revenue nature are taxable as income from business under section 28, provided that the sale is in the regular course of SSC's business or the transaction constitutes an adventure in the nature of trade. Capital receipt versus revenue receipt test of to be applied. Transaction entered into the course of the business. Profit arising from transactions which are entered into the course of the business regularly carried on by the SSC or are incidental to or associated with the business of the SSC would be revenue receipt chargeable to tax. Example, a banker or financial dealing in foreign exchange or sale of shares and securities. A shipbroker purchases of ships in his own name. A sharebroker's purchase of shares in his own account would constitute transaction entered in yielding income in the ordinary course of their business, whereas building and land would constitute capital assets in the hands of the trader in shares. The same would be constituted stock in trade in the hands of a property dealer. Profit arising from sale of shares and securities. In case of profit arising from sale of shares and securities, in the nature of profit has to be ascertained from the motive, intention, or purpose with which they were bought. If the shares were acquired as an investor or with a view to acquiring a controlling interest or for obtaining a managing or selling agency or a directorship, the profit or loss on their sale would be of a capital nature. But if the shares were acquired in the ordinary course of the business as a dealer in shares, it would consider his stock in trade. If the shares were acquired with speculative motive, the profit or loss, although of a revenue nature, would have to be dealt with separately from other businesses. However, securities held by foreign institutional investors which has invested in such securities in accordance with the regulations made under the SEBI Act 1992 would be treated as a capital assets. Even if the nature of such security in the hands of the foreign portfolio investors is stock in trade, the same would be treated as a capital assets, and the profit on transfer would be taxable as capital gains. A single transaction, can it constitute business? Yes. Even if a single transaction may constitute a business or an adventure in nature of trade, even if it is outside the normal course of the SSC business. Repetition of such transaction is not necessary. Thus, a bulk purchase followed by a bulk sale or a series of retail sales of a bulk purchase followed by a series of retail purchase would constitute an adventure in the nature of trade, and consequently the income arising therefrom would be taxable. Purchase of any article with no intention to resell it but resold under changed circumstances would be a transaction of a capital nature, and capital gains arise, however, where an asset is purchased with the intention to resell it. The question whether the profit on sale is capital or revenue in nature depends upon number 1, conduct of the SSC, number 2, the SSC and the quantity of the article purchased, number 3, the nature of the operations involved, number 4, whether the venture is on capital or revenue account, and number 5, whether related circumstances of the case. Liquidated damages. Receipt of liquidated damages directly and intimately linked with the procurement of a capital asset which lead to delay in coming into existence of the profit-making apparatus is a capital receipt. The amount received by the SSC towards compensation for sterilization of profit earning source is not in the ordinary course of business. Hence, it is a capital receipt in the hands of the SSC. Compensation on termination of agency or service contract. Where an SSC receives compensation or termination of the agency business being the only source of income, the receipt is a capital nature but taxable under section 28(2)(c). However, where the SSC has a number of agencies and one of them is terminated and compensation is received, therefore the receipt would be of a revenue nature, since taking agencies and exploiting the same for earning income is the ordinary course of business. The loss of one agency would be made good profit from another agency. Compensation received from the employer or from any person for premature termination of the service contract is a capital receipt but is taxable as profit in lieu of salary under section 17(3) or as income from other sources under section 52(6)(11). Respectively, the compensation received or receivable in connection with the termination or the modification of the terms and conditions of any contract relating to its business shall be taxable as business income. Gift. Normally, gift constitutes capital receipts in the hands of the recipient. However, certain gifts are bought within the purview of income tax. For example, receipt of property without consideration to is brought to tax under section 56(2)(10). For example, any sum of money or value of property received without consideration or for inadequate consideration by any person other than a relative is chargeable under the head income from other sources. For detail, refer chapter 5 of the income from other sources. Diversion of income by overriding title and application of income. The concept of diversion of income by overriding title signifies diversion of income at source by an overriding title before it reaches an SSC. Such a diversion can take place either under legal compulsion or under a contractual obligation or otherwise. An obligation to apply the income in a particular way before it has accrued or arisen to the SSC result in the diversion of income. On the other hand, an obligation to apply income which has accrued or arisen and has been received amounts merely to the apportionment or application of the income and not to its diversion. Sometimes the dividing line between diversion by overriding title and application of income after it has accrued is somewhat thin. When income or a portion of income is diverted at the source by an overriding title before it started flowing into the channel which was to reach the SSC concerned, it could be excluded from his assessable income. Wherever there is such diversion of income, such diverted income cannot be included in the total income of the SSC who claims that there has been a diversion. On the other hand, where income has accrued or arisen in the hands of the SSC, its subsequent application in any way will not affect the tax liability. In order to decide whether a particular disbursement amount to diversion or application of income, the true test is to probe into and decide whether the amount sought to be deducted in truth did not reach the SSC as his own income. It is the nature of application that is to be the decisive fact. There is a difference between an amount which a person is obliged to apply out of his income and an amount which by nature of his obligation cannot be said to be a part of his income. It is the nature of the obligation that is the decisive fact, where by obligation income is diverted before it reaches the SSC if it is deductible, but where the income is required to be applied to discharge an obligation after such income reaches the SSC, the same consequence in law does not follow. In order that there is diversion at source of the income, the obligation is to attach to the source which yields income and not to the income only. This was held in CIT versus Hitaldas Tirthadas 1961, MK Brothers Private Limited versus CIT 1972. In many cases, it would really be a matter of proper drafting of the document creating the obligation, though in substance the result in both the situations may appear similar. For the purpose of tax planning, the concept of diversion by overriding title would have better scope for exploitation than the concept of application of income. This is because, as pointed out above, when income is diverted by overriding title, such diverted income is not taxed in the hands of the person who claimed this diversion. On the other hand, the concept of application of income envisages first the accruing of accruing or arising of income when once it has become which has come within the grasp of the income tax entity. It is liable to income tax whether maybe it is destination or whomever it may be applied for. Therefore, if an overriding charge is created by the SSE, either voluntary or in pursuance of an obligation, whether pre-existing or not, the SSE may be able to invoke the principle of diversion of income by overriding charge. This is of course subject to the clubbing provisions contained in section 62-64 dealt with in chapter 6 income of other persons included in SSE's total income, which have the effect of getting over these principle in some situations. Examples of application of income: Mr. A is liable to pay rupees 10,000 per month to Mr. B, his ex-wife, as alimony. Mr. A, being an employee of ABC Private Limited, instruct the HR department to pay rupees 10,000 per month out of his salary to Mrs. B directly and remit the remaining salary in his account. In this case, the amount of rupees 10,000 per month is an obligation of Mr. A to pay to Mr. B out of his income, and not an income in which Mr. B has had overriding entitlement. In other words, this is the income of Mr. A, which is applied by him to fulfill an obligation and hence includable in his total income, and a mere arrangement to pay a sum directly to Mr. B would not make it a case of diversion of income. Example of diversion of income: Mrs. ABC is a partnership firm in which Mr. A and his two sons, Mr. B and Mr. C, are partners. The partnership deed provides that after the death of Mr. A, Mr. B and Mr. C shall continue the business of the firm, subject to a condition that 20% of the profit of the firm shall be given to Mrs. D, wife of Mr. A. In the instant case, after the death of Mr. A, 20% of profit of the firm payable to Mrs. D get diverted at source by the charge created in her favor as per the terms of the partnership deed. Such income does not reach the SSE firm. Rather, such income stands diverted to the other person, as such other person has the better title on such income than the title of the SSE. The firm might have received the said amount, but it so received for and on behalf of Mrs. D, who possesses the overriding title. Therefore, the amount payable to Mrs. D after the death of Mr. A would be excluded from the income of Messrs. ABC. Classification of income under the 5 head of income. Under the Income Tax Act 1961, for computation of total income, all income of a taxpayer are classified into 5 different heads of income. These are shown below: heads of income: salary, income from house property, profit and gains of business or profession, capital gain, income from other sources. The provision relating to the profit and gains of business or profession, capital gains, and income from other sources are discussed in chapter 3, profit and gains of business or profession, chapter 4, capital gains, and chapter 5, income from other sources, respectively. In this module, the provisions relating to salary, income from house property has been dealt with in detail at intermediate level itself. The ensuing paragraph contains an overview of the income under the head salary and income from house property. Income under the head salary in section 15 deals with the basis of charge. Salary is chargeable to tax either on a due basis or on receipt basis, whichever is earlier. However, where any salary paid in advance is assessed in the year of payment, it cannot be subsequently brought to tax in the year in which it becomes due. If the salary paid in arrear has already been assessed on due basis, the same cannot be taxed again when it is paid. The terms salary, perquisition, profit in lieu of salary are defined under section 17(1). Salary includes monetary as well as non-monetary items. The following deductions are allowable to an individual from the gross salary. Deduction allowable from gross salary. Standard deduction under section 16(1)(a). Standard deduction of rupees 50,000 or the amount of salary, whichever is lower, is to be provided to the employee if the SSE exercises the option of shifting out of the default tax regime provided under section 115BA C1A. However, if the SSE is paying tax under default tax regime provided under section 115BA C1A, standard deduction will be 75,000 of the amount of salary whichever is lower is provided to the employee. Entertainment allowance under section 16(2) only for government employees. Least of the following is allowable as deduction: rupees 5,000 or 1/5 of basic salary, actual entertainment allowance received. Okay. Deduction in respect of entertainment allowance will be available to an SSE only if he exercises the option of shifting out of the default tax regime provided under section 15BSC1A. The deduction would not be available under the default tax regime that is under section 15BSC1A. Professional tax or tax on employment paid by the employer or employee under section 16(3). If the professional tax is reimbursed or directly paid by the employer on behalf of the employee, the amount so paid is first included as salary income and then allowed as a deduction under section 16. Deduction in respect of professional tax would be available to an SSE only if he exercises the option of shifting out of the default tax regime provided under section 15BSC1A. The deduction would not be available under the default tax regime that is under section 15BSC1A. Income from house property, annual value. The processing of computation of income under the head income from house property starts with the determination of income determination of annual value of the property. The concept of annual value and the method of determining is laid down in section 23. The annual value of any house, any property comprising of building or land appurtenant to of which the assessee owner is chargeable to tax under the head income from house property. Exceptions: annual value of the following properties are chargeable under the head profit and gains of business and profession. Profit: portion of property occupied by the assessee for the purpose of any business or profession carried on by him. Commercial property of an assessee engaged in business of letting out of property. It is pertinent to note that any income from letting out of a residential house or part thereof by the assessee being owner shall always be chargeable under the head income from house property. Gross annual value minus municipal taxes paid by the owner during the previous year is equal to net annual value. So if it is residential house, it is always income from house property. GAV would be higher of the expected rent and actual rent received or receivable during the previous year. The expected rent is the higher of the fair rent and municipal valuation, but restricted to standard rent. In the absence of any information relating to municipal valuation, fair rent and standard rent, actual rent would be considered as gross annual value. Annual value of self-occupied property, where the property is self-occupied for own residence or occupied throughout the previous year due to any reason, its annual value will be nil. Provided on other benefit is derived by the owner from such property. The expression unoccupied property refers to the property which cannot be occupied by the owner by reason of his employment, business or profession or at a different place, and he resides at such other place in a building not belonging to him. The benefit of nil or annual value is available only for up to two self-occupied or unoccupied house property, that is for either one house property or two house properties owned by the assessee. The benefit of nil annual value in respect of up to two self-occupied house property is available only to an individual or a chief. No deduction for municipal tax is allowed in respect of such property or properties as annual value means value determined after deducting deduction of municipal taxes. Okay. Annual value of property held as stock in trade. In some cases, property consisting of any building or land appertaining thereto may be held as stock in trade, and the whole or any part of the property may not be let out during the whole or any part of the previous year. In such cases, the annual value of such property or part of the property shall be nil. This benefit would be available for the period up to 2 years from the end of the financial year in which certificate of completion of construction of the property is obtained from the competent authority. Deduction from net annual value under optional tax regime normal provisions of the Act. Deduction allowed from NAV. Let out or deemed let out property. Standard deduction under Section 24A, 30% of NAV. Interest on borrowed capital under Section 24B, fully allowed. Self-occupied property or properties. Interest on borrowed capital under Section 24B, where loan is taken for repair, renewal or reconstruction of a house property. Maximum rupees 30,000 in total for one or two self-occupied property, where loan is taken for acquisition or construction of house property. Acquisition or construction complete within 5 years from the end of the financial year which capital was borrowed, plus certificate of from lender specifying interest payable. No, then maximum 30,000 in total for one or two self-occupied property. Yes, rupees maximum 2 lakh in total for one or two self-occupied property. Taxability of areas of rent and unrealized rent. As per section 25A1, the amount of rent received in areas from tenant or the amount of unrealized rent realized subsequently from a tenant by an assessee shall be deemed to be income from house property in the financial year in which such rent is received or realized, and shall be included in the total income of the assessee under the head income from house property, whether the assessee is the owner of the property or not. In the financial year, section 25A2 provides a deduction of 30% of the areas of rent or unrealized rent realized subsequently by the assessee. Annual value of co-owned property, where the house property owned by co-owner is self-occupied by each of the co-owner. Annual value of the property of each co-owner will be nil, and each co-owner shall be entitled to a deduction of rupees 30,000 or rupees 2 lakh as the case may be under section 24B on account of the interest on borrowed capital if they exercise the option of shifting out of the default tax regime provided in the section 115 BSc 1A. However, the aggregate deduction of interest to each co-owner in respect of interest payable or taken loan taken for co-owned house property, interest if any payable or loan another self-occupied property cannot exceed rupees 30,000 is the case may be, where the house property owned by co-owner is let out. The income from such property shall be computed as if the property is owned by one owner, and thereafter the income so computed shall be apportioned among each co-owner as per their specific share. Deemed ownership. As per section 27, the following person, though not legal owner of a property, are deemed to be the owner of for the purpose of section 22 to 26. In case of transfer of house property by an individual to his or her spouse, otherwise then for an adequate consideration or in connection with an agreement to live apart, the transfer is deemed to be the owner of the transferred property. In case of transfer of house property by an individual to his or her minor child other than a minor married daughter, otherwise then for adequate consideration, the transferor would be deemed to be owner of the House property transfer. Exception: in case of transfer to a minor married daughter, the transferor is not deemed to be the owner. Where cash is transferred to spouse or minor child and the transferee acquires property out of such case, then the transferor shall not be treated as deemed owner of the house property. However, clubbing provisions will be attracted. The holder of an impartible estate shall be deemed to be an individual owner of all properties comprised in the estate. A member of a cooperative society, company, or a other association of persons to whom a building or a part thereof is allotted or leased under a house building scheme of a society or company association shall be deemed to be owner of that building or part thereof allotted to him, although the cooperative society or company or association is the legal owner of that building. The person who is allowed to take or retain the possession of any building or part thereof in past performance of a contract of nature referred to in section 53A of the Transfer of Property Act shall be the deemed owner of that house property. A person who acquires any right in or with respect to any building or part thereof by virtue of any transaction as is referred to in section 26 269 UAF, that is transfer by way of lease or for not less than 12 years, shall be deemed to be the owner of that building or part thereof. Exception: in case the person acquiring any rights by way of lease from month to month or for a period not exceeding 1 year, such person will not be deemed to be the owners. India, subsection 2, subsection 25A. The term India means territory of India as per Article 1 of the Constitution. Its territory, water, seabed and subsoil underlying the such water, continental shelf, exclusive economic zone or any other specified maritime zone and the airspace about territory in territorial waters. Specified maritime zone means the maritime zone as referred to in the territorial waters, continental shelf, exclusive economic zone and other maritime zone Act 1976. Maximum marginal rate is and the average rate of tax. Average rate of tax as per section 2 subsection 10. Average rate of tax means the rate arrived at by dividing the amount of income tax calculated on the total income by such total income. Example: total income of Mr. A who has exercised option of shifting out of the default tax regime under 1 BS is rupees 6 lakhs and tax payable on it including cess is 33,000 and the average rate of tax works out to be rupees 5.63 percentage. Section 216 2 subsection 29C defines maximum marginal rate to mean the rate of income tax included the surcharge on the income tax, if any, applicable in relation to the highest slab of income in the case of an individual AOP or BOI, as the case may be as specified in the Finance Act of the relevant year. Good job. We will continue further in the next part. Thank you.